Welcome to the Stock Guy analysis. You know, in the world of investing, signals are pretty much everything. But what happens when you get two massive, completely contradictory signals at the exact same time? Well, that's the wild story of Bmnr Immersion Technologies, or Bmnr. We got one of Silicon Valley's sharpest investors heading for the exit, just as the biggest names on Wall Street are practically breaking down the door to get in. So yeah, this is the big question, right? When a tech visionary, a guy with a track record like Thiel starts selling his shares, is that a massive red flag? I mean, normally you'd think so. But when Wall Street does the exact opposite, well, that's what makes this whole story so fascinating. All right, let's start with the news that really shook things up, and this came straight from SEC filings. We're talking about Thiel's legendary venture capital firm, Founders Fund. These are the folks famous for making smart early bets on game-changing tech. So when they make a move, everybody pays attention. And here it is. Founders Fund sold off about half of its 9.1% stake. Now, this wasn't just a little trim to rebalance the portfolio. This was a huge cut, and the market's reaction, it was fast and it was brutal. The stock took a nosedive, tumbling over 10% as investors basically panicked trying to figure out why a top backer was getting out. And what makes this so jarring is the whiplash of it all. I mean, think about it. It was their initial investment back in July that got everyone so excited in the first place. The news of them buying in caused the stock to pop 15%. So to see them turn around and sell a huge chunk, it just created this massive cloud of uncertainty. But hold on, just as everyone was freaking out about the selling, a totally different story was playing out behind the scenes. And this one involves some of the biggest, most conservative players in the entire financial world. While a VC titan was stepping back, the giants of Wall Street were stepping up in a really big way. And the numbers on the other side of this are just staggering. JP Morgan, one of the biggest banks on the planet, scooped up almost 2 million shares. We're talking over $100 million here. This was not some small experimental position. This was their single biggest bet on a company with this kind of crypto focus ever. And they were not alone. Not by a long shot. Vanguard, an absolute behemoth in asset management, revealed they'd bought a massive position of their own. Over 2.8 million shares worth almost $150 million bucks. Now, these are not firms known for making wild speculative bets. When they move, it means something very, very different. And this table just lays it all out perfectly. It wasn't just one or two big names. Morgan Stanley upped their stake by 35% to become the #1 shareholder. And at the same time, Cathie Wood's ARK Invest was actively buying more shares, which completely squashed all those rumors that they were selling. This wasn't a trickle of new money. This was a flood of institutional capital. So, this brings us back to the central puzzle. What in the world is going on? You got a venture capitalist, a guy whose whole job is to get in early on the next big thing, selling half a stake. And on the flip side, you have these long-term institutional investors piling in like there's no tomorrow. How do you make sense of that? Well, to figure it out, we have to decode the woo. Okay, so to really understand what's happening, we got to look a little deeper. Because the why behind the sale, it's way more nuanced than it looks on the surface. It's so easy to see a big sale and just assume the worst, right? But in the world of venture capital, the playbook is, well, it's just different. So, at first glance, it looked like a vote of no confidence, like they knew something bad was coming. But when you actually dig into the data, it suggests this wasn't about losing faith in the company at all. It was more likely a strategic move. This wasn't a panic sale. It was a calculated decision to reallocate their capital. And the timing right here, this is the key. Founders Fund got in back in July when Ethereum was trading around $3,000. When they sold at the end of September, the price was in almost the exact same range. So what does that tell you? It tells you this wasn't about cashing in on that crazy stock run-up. It strongly suggests they sold right around their break-even point, a classic move to free up cash for the next venture, not to run from a sinking ship. And this is exactly how a lot of market commentators were seeing it. They didn't see it as an escape. They saw it as a handover. You know, like passing the baton in a relay race. The venture capitalist's job, the early risky part was done. Now it's time to pass it off to the long-term institutional players who would carry it through the next leg of the race. So if the sale isn't really the main story, then what is? Why on earth are firms like JP Morgan and Vanguard suddenly so interested? The answer, my friends, lies in this massive, unconventional, and incredibly valuable asset that Bmnr is hoarding on its balance sheet. This is the real story here. This is the bull case. The company has managed to accumulate a treasury of 3.5 million Ethereum tokens. Let that number sink in for a second. At today's prices, that's worth somewhere around 13 billion. This isn't just a side hustle for them. This is their core strategy to acquire and hold Ethereum on a scale that no other public company has even dreamed of. And just to put that in perspective for you, 3.5 million ETH is nearly 3% of the entire supply of Ethereum in circulation. As you can see here, that makes them a certified whale in this market. And it's this massive treasury that makes them such a unique animal on the stock market. And this strategy is precisely why the big institutions are so excited. Bmnr is trying to become, for Ethereum, what MicroStrategy is for Bitcoin, a publicly traded stock that acts as a direct proxy for the crypto asset itself. Their goal is ambitious, to say the least. They want to hold 5% of all ETH, and they plan on doing it efficiently, using special immersion tech to slash their mining costs. But most important for Wall Street, it's a regulated, easy way for them to get massive exposure to Ethereum without actually having to buy and hold the crypto themselves. It's the perfect institutional on-ramp. So when you start putting all of these pieces together, the whole picture just changes completely. The story shifts from being about fear because an early investor sold to one of excitement as the company grows up and proves its core idea actually works. What we're seeing here is a classic investment life cycle playing out right before our eyes. Step 1. The venture capital firm makes the early high-risk bet to get things started. Step 2. Once the company's main strategy is validated, the VC makes a strategic exit. Step 3. This opens the door for the big institutional players to come in for the long haul. And Step 4. The asset matures, transforming from a risky venture into a more stable holding. This isn't a red flag at all. It's a changing of the guard. And honestly, the overwhelming sentiment from market analysts totally backs this up. They see Thiel's sale as just market noise. The real signal, the thing to watch, is the flood of institutional money pouring in. That's what validates the whole strategy. The smart money isn't leaving. It's just changing hands from early-stage risk takers to long-term holders. And that really leaves us with one final and pretty powerful question. Because what's happening with Bmnr might not just be about this one company. This could be a sign of a much bigger shift in the entire financial world. The moment where crypto-backed assets finally go from being a niche speculation to a core strategy for the biggest players on Wall Street. Don't forget to like, and thanks for watching. If you like our content, please don't forget to subscribe. That helps us a lot.